This is not about people who are destitute. This is about people who are doing everything right. They work. They show up. They try to save. They avoid obviously stupid decisions. They are not reckless. They are not lazy. And yet, at the end of every month, there is still not enough. Not dramatically not enough. Just slightly not enough. Persistently not enough. This is not a personal failure story. This is a structural one. And it operates through 4 very specific traps, each one invisible until you know what to look for. What makes these 4 traps difficult to see is that none of them announce themselves as a single event. There is no one moment where a person can point and say, "This is the system working against me." Instead, each trap operates as a small, repeated tax, a few dollars here, a few hours there, a slightly worse rate, a slightly longer commute applied so consistently, over so many years, that the person living inside it experiences it simply as how life is, rather than as a structure that could, in principle, be designed differently. That is the real subject of this video. Not one bad decision, not one unlucky break. 4 interlocking mechanisms, each reinforcing the others, each operating quietly enough that they rarely make it into a single conversation about why some people who work just as hard as anyone else never seem to get ahead. Trap 1. The liquidity penalty. Being poor is expensive. This sounds counterintuitive until you examine what happens when you don't have a financial cushion. A $400 emergency, a car repair, a medical copay, an appliance failure doesn't get absorbed. It triggers a cascade. The repair goes on a credit card. The credit card carries a 24% interest rate. The minimum payment gets added to an already stretched budget. Something else gets deferred. A bill, a prescription, a maintenance task. That deferral creates its own cost later. Meanwhile, a person with $5,000 in emergency savings pays $400 and moves on. No cascade, no interest, no compounding damage. The exact same event has completely different consequences depending entirely on whether you have a buffer. It is worth slowing down on why this gap widens rather than staying fixed. The first deferred bill, say, a missed minimum payment elsewhere, does not just sit quietly. It generates a late fee. That late fee can trigger a rate increase on the account, sometimes called a penalty APR, which raises the cost of carrying that balance going forward. A lower credit score, the byproduct of the missed payment, then raises the cost of the next loan. This person needs a car loan, an apartment application, even some utility deposits. One $400 emergency, absorbed by someone without savings, does not stay a $400 problem. It becomes a permanent, slightly worse financial starting position for every transaction that follows. The cruelty of this trap is that the people who can least afford to pay the liquidity premium are exactly the ones being charged it. Every overdraft fee, every payday loan interest rate, every short-term credit product, these are taxes on not having money. This is sometimes called the poverty premium, and it shows up in places far beyond credit. Someone who can pay a full year of car insurance up front typically receives a meaningfully lower rate than someone who must pay monthly because the insurer prices in the administrative cost and default risk of monthly billing. Someone who can afford a large applicants with a higher upfront price but lower long-term operating cost saves money over years that someone forced to buy the cheapest available unit cannot access. At nearly every financial decision point, the option that costs less in total is the option that requires more cash on hand right now, and the people without that cash on hand are systematically routed toward the option that costs more. None of this requires anyone to act in bad faith. Lenders are pricing real risk. Retailers are responding to real demand. But the cumulative effect across an entire financial life is a tax that falls almost exclusively on people who do not have enough cash buffer to avoid paying it. Trap 2. The time tax. Poverty does not just take money. It takes time. And it takes time in ways that make building anything nearly impossible. When your financial situation is precarious, an enormous amount of cognitive and logistical energy goes into managing that precariousness. Navigating assistance programs, dealing with billing disputes, managing multiple jobs with unpredictable schedules, arranging transportation when a car breaks down, handling the cascading consequences of the liquidity problems we just discussed. This is sometimes called the bandwidth tax, the cognitive load that poverty imposes. Research from Princeton and Harvard has shown that financial stress can reduce effective cognitive capacity by the equivalent of roughly 13 IQ points, comparable to the effect of a sleepless night. It helps to understand why this effect is so consistent and so measurable. The human mind has a limited amount of what researchers call cognitive bandwidth. At any given moment, the capacity to plan, to focus, to resist short-term temptation in favor of long-term benefit. Financial scarcity does not just create stress in the background. It actively consumes a portion of that bandwidth, because the mind, quite reasonably, keeps returning to the unresolved problem of not having enough. A bill due in 4 days does not stay contained to the moment someone thinks about paying it. It intrudes, repeatedly, into unrelated tasks, concentration at work, patience with a child, the ability to read a dense paragraph and retain it. This is why financial stress can produce decisions that look, from the outside, like poor judgment, when they are in fact the predictable output of a mind operating with less available bandwidth than it would have under less precarious circumstances. The trap compounds itself. Less bandwidth makes the underlying financial problems harder to solve well, which extends the scarcity, which further taxes the bandwidth. The trap is this: the behaviors and investments that lead to financial improvement, education, skill building, networking, strategic planning require time. And the people who most need those investments have the least time to make them. It is not laziness. It is mathematics. There are only 24 hours, and they are not distributed the same way across different financial circumstances. There is also a scheduling dimension to this trap that deserves its own attention. Many lower-wage jobs use software-driven scheduling systems that optimize staffing levels around predicted customer demand, sometimes generating work schedules with as little as a few days' notice and shifts that change week to week. This unpredictability makes it extraordinarily difficult to arrange consistent childcare, enroll in a structured training program, or commit to a second source of income, all strategies that, in theory, could improve someone's financial position, but which require a level of schedule stability that an unpredictable job actively prevents. Trap 3. The cost of appearances. Modern poverty operates in a world of visible signals. Employment, social status, and opportunity are often gatekept by the ability to present a version of financial stability you don't actually possess. The professional wardrobe for a job interview, the functioning smartphone that connects you to opportunity, the address that doesn't signal the wrong zip code to a potential landlord or employer, the LinkedIn profile that looks like confidence. These are not luxuries. They are access requirements. It is worth being specific about how this signaling functions, because it is rarely a single decision-maker consciously discriminating. It is, more often, dozens of small filtering decisions made quickly, almost automatically, by people who are themselves under time pressure. A hiring manager scanning 50 resumes in an afternoon. A landlord comparing applicants with a property that will sit vacant if a decision takes too long. Each one is, often unconsciously, pattern matching against a mental model of what reliability looks like, and that mental model is frequently built from visible markers of existing financial stability, not from the underlying competence or trustworthiness those markers are assumed to represent. This means the signal itself becomes a kind of currency, separate from and sometimes more immediately valuable than the qualification it is meant to represent. Two candidates with identical skills can receive very different outcomes based entirely on whether one of them was able to afford the visible markers the gatekeeper was unconsciously screening for. And so people making $35,000 a year sometimes make financial decisions that look irrational from the outside: the car that's slightly too expensive, the clothes that stretch the budget, because they understand intuitively that the appearance of stability is required to access the opportunities that would provide actual stability. The trap is elegant and vicious. You must signal wealth you don't have in order to gain access to the means of acquiring it. And the cost of those signals comes directly from the budget that might otherwise build a real foundation. This dynamic extends into digital life as well. A reliable smartphone and consistent data plan are no longer conveniences, they are often the only channel through which job applications are submitted, shift schedules are received, and benefit paperwork is processed. A cracked screen or a lapsed data plan is not merely an inconvenience in this context. It can mean missing the single notification that determines whether a shift, an interview slot, or a benefits deadline is met. The cost of staying visibly connected has become, functionally, a cost of staying employable. Trap 4. The neighborhood cost. The fourth trap is perhaps the least discussed, because it is the most structural and the least amenable to individual action. Where you live determines what you pay for nearly everything. Grocery stores in lower-income neighborhoods charge more on average than those in wealthier areas while offering fewer quality options. Insurance premiums are higher. Banking services are more expensive. Healthcare access is more limited and more costly when accessed. The schools in underfunded zip codes provide fewer pathways to credential and opportunity. The social networks available in lower-income communities contain fewer people who can offer job referrals, mentorship, or capital introductions. The geography of poverty compounds poverty. The grocery dimension of this trap is worth examining closely, because it is one of the clearest examples of how geography compounds cost. Large, full-service supermarkets with the lowest per-unit prices tend to locate where population density, car ownership, and disposable income support their business model. Many lower-income neighborhoods are instead served primarily by smaller convenience stores and corner markets, where the absence of competition and the higher cost of smaller-scale distribution translate directly into higher prices for the same items. A household with less money to spend on food often pays more per item for that food than a household with more money to spend, not because of any difference in shopping skill, but because of which stores are within a reasonable distance. Banking access follows a similar geographic logic. Traditional bank branches have closed disproportionately in lower-income areas over the past 2 decades, leaving check cashing services and other alternative financial providers, which typically charge meaningfully more for basic transactions, as the most accessible option for many residents. The absence of a nearby bank branch is not a minor inconvenience. It is a recurring fee embedded into the cost of simply accessing one's own money. And moving is not a simple solution. Moving costs money: security deposits, first and last month's rent, transportation, lost work hours. Moving away from a neighborhood means leaving behind the informal support networks, family, friends, childcare arrangements that make survival possible in the first place. The trap is geometric. Every wall holds up 2 others. Remove one, and the structure shifts in unpredictable ways. The person inside is not trapped because they lack the will to escape. They are trapped because the exits are expensive, and the cost of a failed attempt is catastrophic. Trap 5. Why the traps reinforce each other. Looked at individually, each of these 4 traps is survivable. A person could, in principle, absorb the cost of one of them and still make steady progress. What makes modern poverty so durable is that the traps rarely operate in isolation. They interlock, and each one makes the others harder to escape. Consider how directly they feed into one another. The liquidity penalty consumes the cash that might otherwise fund a move to a lower-cost neighborhood, reinforcing the neighborhood trap. The neighborhood trap, through longer commutes and less reliable transit, consumes the time that might otherwise go toward the skill building that could increase income, reinforcing the time tax. The time tax leaves less bandwidth to research a better insurance rate or negotiate a bill down, reinforcing the liquidity penalty. And the liquidity penalty, by forcing visibly cheaper choices in clothing, transportation, and presentation, reinforces the appearances trap, narrowing access to the better-paying opportunities that might have provided a way out of all 4 traps simultaneously. This is why advice that addresses only one trap at a time so often falls short. A budgeting tip that ignores the cognitive bandwidth tax assumes a kind of sustained mental energy that scarcity itself erodes. A career tip that ignores the appearances trap assumes a level of starting capital that may not exist. None of these traps were designed, individually, by any single architect with the intention of trapping anyone. But the interaction between them produces an outcome that functions exactly like a trap, regardless of intention, self-reinforcing, difficult to exit from any single point of leverage, and remarkably persistent across a person's life, and often across generations. 4 traps, each one self-reinforcing. Each one designed not through malice, but through neglect, a system that accumulated these features over time, without ever fully accounting for the compounding cost they impose on those already at the margin. The solution is not simply to work harder. The 4 traps described here are not overcome by effort alone, because they tax effort, time, and money simultaneously. But seeing the trap is the beginning. Because once you can name what's holding you in place, you can begin to build a strategy around it, rather than against it. Understanding the architecture does not, by itself, dismantle it, but it changes the starting question. Instead of asking what is wrong with the person inside the trap, it becomes possible to ask, what is wrong with a structure that requires so much from people who already have so little to give it? The anatomy of modern poverty is not a character study, it is a systems diagram.